Hello everybody, and welcome once again to an NZX hosted virtual investor event. My name is James Sharp. I work on the origination team here at the exchange. I hope everyone is well from wherever you're joining us this morning. Just a quick reminder of format. So we're actually going to hear 4 presentations today, each about 15 minutes long, after which there'll be 5 minutes designated for Q&A. To ask a question, please do so via the webinar chat panel. There's a free text field box. You can ask your question there. Just for the sake of keeping things flowing, we do ask that if you do come up with a question during the presentation, send that through to us. It just gives us time to collate after each one of those presentations. And anything we don't get to today, as usual, we'll get answers over to you after today. That's enough from me. So without further ado, I'd like to introduce Fisher Funds to the floor. Fisher Funds is one of New Zealand's largest specialist investment managers, with over 250,000 Kiwis invested across KiwiSaver and managed funds. They have been operating for over 20 years. And here this morning to talk about Kingfish, listed on NZX, is Matt Peake, Portfolio Manager. Matt, good morning to you. I can see your presentation. I'll leave it over to you, and I'll be back in a few moments for some questions. Cheers, Matt.
Very good, James. Well, thank you, and good morning, everyone. I will be giving you a run through of Kingfish this morning. So I'm Portfolio Manager for New Zealand equities at Fisher Funds. So I manage all the unlisted New Zealand funds there, and also Kingfish, which is our listed investment company, investing in New Zealand companies. So what are the basics you need to know about Kingfish? So first and foremost, Kingfish is almost 20 years old now. It's been around since March 2004. It's a listed investment company. Its ticker on the NZX is KFL. And it owns shares in New Zealand companies worth around $465 million. So its purpose is to invest in New Zealand companies, and its focus is very much on investing in quality New Zealand growth companies. So me and the team at Fisher Funds actively manage the portfolio. So we make the investment decisions about what companies go in Kingfish, and how we change the positioning around as things change. Kingfish has an independent board of 4 that oversees how we manage Kingfish. So it has that rigor around it. And we also, it's probably worth noting a couple of things. Kingfish has a tax efficient pie structure, and it pays a 2% quarterly dividend. So 8% of the net assets of the fund get paid out in distributions every year. So the goal of Kingfish is to achieve a high real rate of return, and this comprises both income and capital growth within acceptable risk parameters that the board helps set. So what companies do we own? Overall, Kingfish attempts to provide a balanced portfolio, but a concentrated portfolio of companies with strong medium and long-term growth prospects. So you can see them here on the picture. There's 15 companies currently in the portfolio, and as you can see, a lot of those are some of the companies in the market that have delivered the best returns over long periods of time, the likes of Infratil, Main Freight, Somerset, Fisher & Paykel Healthcare, as you see there. So the companies that we tend to own generally have greater exposures to sectors that have longer term growth trends. So included in these are healthcare, retirement, as you can see there. We sort of have had software companies. We've only got one at the moment, but they tend to have stronger growth prospects as well, and logistics too. And we also have a range of infrastructure companies, as you can see there, which adds a defensive element to the portfolio, although these also tend to be more growth orientated. In particular, Infratil invests in most of its infrastructure assets that have strong growth characteristics. So when we sit back and look at this portfolio, ultimately this is a portfolio of Kiwi growth companies that I'm really proud to own. So you might be thinking, how do we actually get there? What's our investment process? Why do we land on these companies? So I'll briefly talk a little bit about what we look for in choosing the companies for our portfolio. So we try to look for three things really. The first thing is a wide economic moat. So, businesses have ups and downs. The economy goes through strong patches and weak patches, and we need our businesses to be resilient, to withstand competition, to withstand the tough times and come out stronger. So we need our businesses to have, operate in a way that's unique and really gives them a competitive advantage versus other companies out there that are trying to do similar things. We also try to invest in companies that have long runways for growth. We need them to be able to reinvest in the business and grow their capital and the business's earnings at strong rates for a long period of time. The third thing that we really look for is strong culture and management. It takes people to run businesses, and we need to back people who have skin in the game, who think like a business owner, and who make good decisions when deciding how to grow the business and allocate capital. So the way this all boils down in our framework is we have an acronym, STEEP, that you can see up there on the screen, which explains these things, and you've got to tick each of those 6 boxes to get a place in the portfolio. So the business needs to have great strength, it needs a strong moat, it'll often have demonstrated this through a really strong track record, not just over a couple of years, but over many years of growth and returns. And that translates to a strong earnings history too. We like the earnings outlook, not just over the next couple of years, but over 5 or 10 years to be really positive. People referring to not just the management team, but the board and the culture of the company. And the last thing we look at is any great company can be a mediocre investment if you pay the wrong price for it. So we also pay attention to the price, but I guess that comes last for a reason. We don't tend to buy poor businesses just because they look cheap, hoping that they're going to be more highly valued in the future. We like to back the businesses that are winners over time, that have those first characteristics. And you can really see this when you sort of look at our portfolio versus the average company in the benchmark index. So this chart shows the median company in our portfolio versus the median in the benchmark across a range of measures on quality and growth. And what I'd call out here is that you can see that our companies score well on balance here. So the first bucket in quality is return on capital employed. So that's a key measure we look at to see whether our companies have good business models. And what that tells you is that for every dollar that's invested in our business that's been reinvested over time, it generates more profits than the average company in the benchmark. Our companies also have higher profit margins when you exclude property companies. So they generate more profits for each dollar of sales that they generate. There are a couple of other important quality measures here that aren't shown. It's probably also worth noting, especially in this environment, that our companies tend to have less debt and less, interest burden than the average company too. And then on the right-hand side, I guess that shows our growth characteristics shining through. On a look-forward basis, we expect our companies to have higher growth in earnings, but then also sales. And although this shows the growth in the immediate outlook, we're really trying to back companies that have growth rates that can sustain, not just for a couple of years, but for 5 or 10 years. Just taking you through a bit of an example of one of the companies in our portfolio and how we think about it through this lens. and then also how we sort of have actively managed the position recently. So Fisher & Paykel Healthcare is a high quality business, possibly the highest quality business in the New Zealand market. It's been a core position in the fund since October 2009, so that's 14 years now. What do we like about it through our steep lens? First of all, the moat of the business is really significant. So in its core nasal high flow product, where it treats hospital patients with respiratory problems, it's much larger than the next largest player. So it has over $1 billion of sales, and its main competitor has less than 100 million of sales. And that scale really lets Fisher & Paykel reinvest heavily into the business. Over the last 10 years, it's cumulatively invested around $1 billion in research and development, and it spends $200 million annually on further research and development, which enhances its products versus its competitors and allows it to launch into new areas. And the recurring feedback we get when we talk to pulmonologists and respiratory technicians is that its products are better than the competitors. I guess a couple of other ways that this manifests in its moat is it has over 500 patents in the US alone, and over 1,000 studies, clinical studies, looking at its key therapy, have been published in the last year or so. So it's really truly significant business with a leadership position, and it has a really significant global market share. So with that, I guess built off that success and a strong moat, really it's had a great track record of being able to grow its earnings as it gets its therapy into hospitals around the world and gains acceptance off the back of more of that clinical evidence. But then the thing we really like is on a look forward basis, there's still plenty more runway for growth. So if you think about the last year, it treated around 20 million patients globally. If you look to what the size of its total market is, it's around 250 million patients. So even though it's grown very significantly over the last decade, over coming decades, there's still plenty more room for the business to grow from that position of strength. Onto the next page. Of course, one of the things we do with the portfolio is we manage it actively. And because of our long-term lens, we can sort of take advantage of opportunities that others might not see when companies have short-term transient setbacks. So we tend not to fixate on short-term dynamics and try to look through them to see the bigger picture. So when we think about Fisher & Paykel Healthcare, we saw this happen in the last year, where some of the sales results and profit results were really probably weaker than expected, but this was heavily driven by hospitals destocking inventories after COVID. And so the share price had a bit of a slump to $20 or below, and in those, at that time we were buying significantly shares for Kingfish because we knew these were short-term dynamics. And what gave us the confidence to do this? All our research was telling us that the long-term fundamentals were intact. We had a lot of calls with practitioners. We have a lot of confidence that the company's therapy still has a lot of runway to grow. Secondly, the market had really ignored some of the new product launches that the company was particularly excited about and investing a lot behind in terms of sales. So those, that's a key aspect of the business model, and the company expects to be able to double sales every 5 to 6 years through launching new products. And these, to put it in context, these products that the company launched, have an addressable market of 50 million patients or $5 billion per year. So a truly significant opportunity for the company, completely ignored because of a short-term dynamic. And then in addition to that, we were getting some more comfort that the destocking was fading from the research that we were doing and the channel checks we were doing. And so we had confidence that there would be a recovery. And then in the next 6 months, the share price was up around 20 to 30% after we had increased our position. So that really, I guess, shows an example of how we're always managing the portfolio to take advantage of the opportunities we see. So what does this all add up to? What's our track record? So this slide shows the performance of Kingfish long-term versus the market for the last almost 20 years. The blue sort of mountain is the returns of the New Zealand market, which is pretty impressive. $100,000 invested back when Kingfish started would be worth $460,000 today. But then, even though it doesn't look much and it's a gradual sort of improvement, the outperformance that Kingfish has delivered has really, I guess, accumulated over time. And so $100,000 invested in Kingfish at inception would now be worth $640,000, which is 40% more than just investing in the New Zealand market. And so that really comes by backing some of these high quality growth companies over a long period of time, and then actively managing the portfolio to take advantage of opportunities that we see. So I guess wrapping it all up, what is Kingfish? Why would you invest in Kingfish? So Kingfish is a relatively simple way to access a high quality portfolio of Kiwi growth companies. We manage the portfolio actively, so you don't need to think about trading in and out of companies. We make those decisions. We're thinking about it every day using our process, which has been proven over a really long period of time. Even in the last 5 years, our track record's really good. We're well ahead of the market, and also up in the top echelon of similar products in the New Zealand market. So those are really the key things why you'd invest in Kingfish. Also, we think the pie structure is really tax efficient, and the quarterly dividend is something that our clients, our shareholders really value, and that can be either taken as a cash dividend or invested in new shares as well. So that's it from me, really. An overview of Kingfish. Obviously, if you need more information, you can feel free to jump on our website, kingfish.co.nz, or reach out to the Fisher Funds team directly. And that's it from me, really, and I'm happy to take any questions.
Thanks very much, Matt. I've just switched to a headset, just making sure you can hear me.
Yep, loud and clear.
Fantastic. Okay, we've got a couple of quick questions here, or a couple of questions, I should say. Question one is, how does Ryman meet your criteria?
So, notwithstanding our, some of the challenges it's had recently, Ryman we really like still because the business model is really strong. So, and backed by the growing and aging population too. So every dollar that they invest in a village can get recycled as the village is sold down and reinvested into new villages. And then as over time, that those units get turned over and Ryman benefits from the cash flows that they get there. So we still think, given the challenges that Ryman's had, we had used our active management to decrease the position significantly, given some of the headwinds and some of the balance sheet problems. And we recently upweighted that position in the equity raising too. So I think, the company's been through a bit of a rough patch. We still think the fundamentals are intact. Some of those problems have been cleared up, so we're happy to own it going forwards.
Yeah, interesting, I guess, reflecting on your focus of longer term views versus that kind of short term volatility. So great, thanks for that. And then second question here is Kingfish's focus on New Zealand only a severely limiting factor compared with schemes that operate in international markets?
I think the answer is yes and no. Obviously I can't provide tailored financial advice, but you can own Kingfish as part of a portfolio if you want other exposure to offshore markets. One thing that we really like about investing in New Zealand is we have really good access to the companies and their management teams, so we can really truly understand these businesses, you know, up close and personal. And you know, because we've only got 15 companies in the portfolio, we can spend a lot of effort sort of thinking more deeply and doing deeper work on some of these companies than others might. So we really think that's you know, a part of our strategic advantage as investors here, and that can offset some of the, you know, potentially the smaller universe of companies, but there are other ways that investors can access those companies.
Fantastic, thanks, Matt. That's it for questions. I do just remind viewers to send any subsequent questions through, and we'll get Matt to answer them. Matt, I think we'll leave it there. Thanks very much for your presentation this morning, and catch up with you again soon.
Thanks, James. Thank you,
everyone. Cheers, Matt. Thanks. Thank you very much. Bye-bye. Excellent. We're going to move on to our second presentation now, and that's going to be from Booster. We're actually going to hear two presentations from Booster. So Booster are a proudly Kiwi-owned and operated independent financial services company based in Wellington, and have been looking after New Zealanders' money since 1998. Booster have two funds listed on NZX in the form of the Private Land and Property Fund and the Booster Innovation Fund. And today we're going to hear from a couple of people from Booster. First of all, and right on time, is Chris Westbury, Associate Director of Direct Investments. Very good morning to you, Chris. I think you'll just bring up your presentation there. So again, just to reiterate, if you do come up with think of questions, we do suggest you kind of send those through as they sort of come into your head, so we've got time to collate them, and then we can maximise the use of that 5 minutes of Q&A. Chris, I can see your presentation, so I'm going to leave it with you, and I'll be back in a few moments with some questions. Thank you.
Cool. Thanks a lot, James. Thanks for that intro as well. You probably stole a bit of my first slide, but that's okay. We'll forgive you on that. So yeah, my name is Chris Westbury, fund manager here in the direct investments team. So I'll firstly speak around the Private Land and Property Fund, and then hand over to Melissa, who's actually right next to me, to talk about the Booster Innovation Fund. So yeah, look, just a little bit about Booster before we jump into it. As James said, we've been around for around 25 years now. We're primarily owned by staff or ex-staff. Our core business, KiwiSaver business, we were appointed a default provider in 2014, and then reappointed in 2021. We have around, depending on the market, 6 billion of funds under management, and that's across around 180,000 retail investors, clients. What we kind of decided 5 or 6 years ago now is that it's not fair for those retail investors to miss out on a huge slice of the economy, being the private markets. So we were one of the earlier pioneers to set up direct investment activity for a KiwiSaver or super fund back in 2017. So look, where are we now in that journey? 93% of our funds are still in global and domestic listed traded markets, but we have around a 7% allocation to direct investments, and that really does represent one of our key differentiators to other funds. That's spread across 3 key offerings currently. Tahi is our wholesale private equity fund. That primarily partners with SMEs, small medium enterprises, for the long term with a real sustainable income focus. And the 2 listed funds that we're going to talk about today, the Private Land and Property Fund, that obviously, what it probably implies with its very creative name, invests for the long term in productive land and property. And also the Booster Innovation Fund, which is our early stage venture capital type fund. So just jumping into the private land and property fund. So some of you might have had a bit of a romantic notion at some point of going out and making that lovely investment in a vineyard, or perhaps an orchard growing some of your favourite fruit. Then you start to think about the practicalities of that. You know, putting all your money into one investment, who's going to run it? Will it actually make any money? And then, you know, each time you go to bed each night, you might be wondering how frosty it's going to be. Which, if you're in Wellington, was definitely real this morning, given how iced up my car was. Or look, perhaps on a more simplistic basis, you've got a share portfolio. You might have a rental property too, and you're just looking to broaden your investment horizon without allocating more to, say, you know, an offshore index fund or something. That's really where the private land and property fund can come in. It offers retail investors a slice of what you could call New Zealand's rural paradise that is otherwise really hard to access or is quite impractical unless you have really deep pockets or really deep knowledge into a specific crop or produce. So, look, quick overview of the fund where we're at now. Obviously, we invest in productive land. What that's meant is to date we've developed a diversified portfolio of 145 million of gross assets across 7 different investments so far. We have a target return of 6.5% on a long-term 7-year basis. Since inception, around the 5-year return, we've actually shown returns of over 12%. So we're really pleased with the start that we've made. That income or the returns really comes from a couple of key different sources. First of all, lease income or sale of crop produce, depending on the setup of the investment that we have. Also, what we do recognise is when we buy, say, a maturing property or a bare land property, and we convert that into, say, a working vineyard or something. What comes with that is a development gain over time, and we have recognised that gain in value from maturing properties and maturing assets. We also, like anyone else, subject to market movements, and over the past 5 years since inception, we have enjoyed a relatively favourable market revaluations as well, which has driven part of those returns. But saying that, that's not one of our key focuses. Those 3 points on the screen there being sustainable income and realising the gain in value from maturing properties is our key focus. Graph over the other side there just outlines at a high level the types of investments we've made. So how did we get there? It's just a quick overview of how we've built up the fund over the years. The first port of call to gain scale was the investing into a couple of vineyards. They're actually leased to an operating wine company with a majority shareholder sits in the Tahi Fund. That provides a couple of benefits for us. First of all, we obviously know the operator really well and we trust them. We know they're going to be a sustainable long-term operator of the land, and they're basically going to treat it like it's their own. That really pays dividends for us as a landowner, because ultimately well looked after land becomes more productive, and eventually that will be capitalised into value. Since then, over the last couple of years, we've really focused on a wider diversification story, and you can see there we've made investments into kiwi fruit, hops, some other horticultural classes, and also the latest investment was some dairy farms that we leased down in Southland. So just putting the portfolio on a map for you, you can see we've invested from the very tip of the North Island in the far north with our avocado orchards, right down to the engine room of dairy. We actually own a farm basically on the south coast outside of Invercargill. What's been interesting with that geographical diversity is it's been at the forefront of investors' minds recently with some of the weather events and cyclones we've had. So we've found that this geographical spread has really paid off for us. It meant that only a portion of that asset base kind of in the upper half of the North Island was affected. And also our other mitigant around that is we do like to make sure that lease properties form the core basis of the portfolio. So we find even if there is crop damage on some properties, ultimately we don't actually wear the loss of that income that falls with the operators. Just moving on to a little bit more about our operating model. As you can see, I'm sitting here in an office with a shirt on, so I'm not a farmer, nor will I ever profess to be one. I think that the closest I've got would be milking one cow on a visit to our Southland. So look, what I'm trying to say is we're hands-off managers, and we leave the day-to-day management and operation to either our partners or our lessees. We're more focused on building a portfolio of development sites, maturing sites, and also fully mature properties in order to continue delivering the long-term sustainable returns to our investors. Point two there, we're also really careful with the selection of our managers and lessees. But this covers a kind of a number of key criteria that we look at. First of all, just in terms of that land stewardship and sustainability of how they run their business is really important to us. And also goes without saying, creditworthiness and credit checks. We want to make sure that they can sustainably operate the properties today, but also over 5, 10, 15, 20-year horizons. What this also means is we're not entirely focused on squeezing every little last bit of yield out of say our lease terms. We prefer that our lessees, as I said, can manage their properties economically, and really we want them to have the flexibility to manage it efficiently and effectively, and that ultimately, as I said earlier, will be rewarded with more productive and well looked after properties. Diversity, covered that a bit on some of the other slides, but building diversity across the portfolio is a real key strength of ours that you can't obtain by going out and doing this on your own. That's normally looked at in 3 different ways: geography, diversity of geography, operator lessees, and also different types of land use. So if anything happens specifically to one sector, think maybe PSA for kiwi fruit, that we're not overexposed to an event like that. Last bit there as well was having a stable income base for the core of our portfolio is really important. In terms of leased properties, that represents around 73% of our asset base by value. They're all long-term leases. Out of those leased properties, our weighted average lease term is 14 years. And all of them have some kind of inflation protection built in, with regular market rent reviews every 3 to 5 years, depending on the property type. So what does all this mean in practice? I thought I'd just do a case study of one of our recent investments, and for that I thought I'd run through our hops business. Most people ears prick up when we start talking about hops and beer. It's can be a bit more interesting than just your standard old avocado or kiwi fruit or something. But look, quick overview of hops. For us, we identified it as a real growth sector in New Zealand. We have incredibly high quality hops in New Zealand that are really sought after overseas and actually command a reasonable price premium due to their specific aroma characteristics that are well suited to a range of beers, but particularly the kind of the in-trend craft beers like the hazies and such. It's also, interestingly enough, an industry where the kind of the good farming, water and land story of New Zealand really comes together with some innovation. In the background, Plant and Food New Zealand have actually been busy developing new plant varieties to grow here that have actually resulted in a whole lot of new specific hops that are only native to New Zealand coming out. A couple of the most recent ones from that are called Nectaron and Superdelic. You may have seen Nectaron in some of your beers. Look out over the next couple of years for Superdelic. It's a really new, exciting hop variety that I actually haven't tasted any yet, but it's pretty exciting to see that innovation happening and really partnering with our good provenance. So in terms of investment, we're a 50% owner of Waimea West Hops. We put in $7 million in 2021 to really transform it from a property with potential to really scale it up and increase the efficiency. So you're probably now, over the last couple of minutes, been wondering what you're staring at on the screen there. So that's actually a 1960s Bruff hop processing machine. That has been on its last legs, fair to say, after 65 odd years. In our first couple of years of ownership, we still ran that machine, and we were kind of crossing our fingers, hoping that it wouldn't blow up at us. So what our investment has brought to Waimea West is, in one part, a new processing facility. So what you see there is a brand new DK fad machine that was imported from the US, and that has, not only does it produce outstanding quality hops, but also it can probably do around triple to quadruple what the old machine did. So for our operator Ben there in the high-vis vest in the foreground, it's a pretty big change for him, and it's really exciting to see what our money can do on the ground to our rural economy. Also, some of our investment helped expand the farm footprint from around 29-30 hectares up to its current size of 62 hectares. And we've got real aspirations to keep growing beyond that. We're excited of what the hops industry can do in New Zealand. So just jumping back a few more details around the fund that I should mention. As I said, started in 2017, we listed in 2019. The price history generally has tracked fairly close to NTA on NZX, and our NTA is based on independent valuations that we commission. We commission those every 2 years. However, in between that, on a continuous basis, we as management review the market conditions. We regularly visit and review what's happening on the properties. And our investment committee also meets quarterly to undertake a real deep dive on what the market is doing and new opportunities and what's happening on the properties. We're a listed pie as well. That can bring certain tax benefits to some investor sets, and we do have the ability to gear the fund at a soft limit up to 40%. Currently, we're geared at around the 10% mark. Should also mention that in terms of the investor base, over half of the money comes from direct retail investors, and around 45% is from KiwiSaver and super funds within Booster who had an allocation to this asset class. Quick overview of the returns, fees and investing. We charge no performance fee, we charge no transaction fee, unlike some of the other wholesale private offerings in the rural space. We just charge a flat management fee of 1% plus property expenses running at about 0.19% at the moment. There's two key ways you can invest, obviously through liquidity on the NZX, and also Booster as manager issues and redeems units at NAV, and for redemptions below 50,000 per annum, there is no withdrawal fee. On the table there, that just outlines the track record that we've built from our unit pricing and a quick graph of the share price. We're pretty proud of what we've achieved over the past 5 years. We're running well above our target of 6.5%, but as we did mention before, that is partially due to a nice tailwind of some favourable market valuations. So look, overall, we've built up an investment vehicle that enables retail investors to have their own little slice of rural New Zealand, something that New Zealand is good at. You can do that whilst retaining liquidity and essentially gaining diversity in this sector overnight. We have a low fee structure, relatively stable income flows from the majority of our assets being leased. And look, we really wanted to democratise this sector for the average retail investor, with a sector that's generally only really available to those with deep pockets, really deep knowledge in farming. So look, thanks very much for the opportunity to speak today on what we're doing with the Private Land and Property Fund. And look, if you've got any questions, more than willing to answer them now or after Melissa's chat on the Innovation Fund.
Thanks very much, Chris. Yes, we do have some questions. We might actually get all of them today, so apologies to people who've asked those. But should we ask a couple now, Chris, and then we'll probably pass on to Melissa. So I'll ask question one, which is with growing scrutiny and regulation in the dairy industry, what are your plans for future investment?
Yeah, look, dairy is a sector that New Zealand is really good at. A couple of things we're doing is really assessing the operator on the farm and their farm plans around sustainability. And look, New Zealand is actually a real leader in the dairy space. Dairy is an important protein and food source, and it's not going to go away in a hurry. And our carbon footprint for the average farm in New Zealand is vastly less than the average worldwide. So in terms of that, dairy is something that New Zealand is good at and should continue to do, albeit we need to make sure that we're doing everything we can to manage and reduce that carbon footprint, and we're in continuous discussions with the operators around what they're doing, what their plans are, and how they're really managing that valuable asset that we have.
Great, thanks, Chris. The second question, I think you might have answered already, but I'll ask it anyway. To what extent are environmental factors taken into account when you make investments? What provision are you making for climate change? Sorry, anything you want to reflect or highlight again?
Yeah. Look, it's a really good question. It's similar vein to the dairy investment. In any investment that we look at, we look at with a really strong sustainability lens as well, in terms of, as I said, what the operators are doing, what that footprint is. Are there any other avenues or things that we can do to ensure that the land is utilised in the best way? In the past, to give another example of that, we've undertaken a relatively large native tree planting program on some of the unproductive areas of around our vineyards in Marlborough. So if the lessees or operators come to us with any ideas around that, we're more than willing to hear it. We're more than willing to fund it, because this fund is about long-term investment, and we want to make sure that we're here in a strong position in 10, 15, 20 years' time.
Fantastic, thanks, Chris. The other two questions we'll flick over to you separately, because I think just in interest of time we'll move on. So Chris, thank you very much for your presentation this morning. So I'd like to then hand over to thanks, Chris, to Melissa Giannotsos, Innovation Fund Manager of the Boost It Investment Fund. Melissa, over to you, back in a few moments for some questions. Thank you.
Great, thanks, James. It's a real pleasure to be here today. So as James said, I'm Melissa Giannotsos from the Innovation Fund. And what's quite exciting in terms of our journey is we've now surpassed 1 year on the exchange, and what we are seeing is that we're generating returns where, and this is in the context of the current economic climate, which has been quite tough for younger companies. Many of the companies we support and the investors that we syndicate with are showing real resilience and have been able to adapt in response to the current conditions. Today, I'll take the time to describe the startup asset class. Our investment approach will spotlight a couple of the companies in the fund and then describe how we're mitigating the inherent risk in this asset class. So let's start in terms of why we're focusing on innovation. We have a real strong belief that investing in these young companies early will generate some long-term returns for our investors. So getting behind these homegrown solutions is critical, and we think it's going to provide a real input into helping changing the fabric of our economy. This will be seen in the way of high-value job creations. How do we retain more of the value of these innovative ideas and shared knowledge in New Zealand for longer? And then ultimately that really improving the standard of living for all Kiwis. So there's several reasons why we think it's possible here in New Zealand. So New Zealand's got a strong culture of innovation, and we've seen time and time again that we are making world-changing discoveries and building companies on those. And we're seeing some of that in our portfolio, but some of note, we're seeing a lot of our scientists being recognised internationally. So it's really inspiring. The other factor is that the New Zealand Tech and Innovation Centre is growing, and they recently took the #2 spot in being New Zealand's highest export earner. It has been growing 77% faster than the general economy in the past 7 years. Also, the capability and capacity of New Zealand's venture investment community is growing, and over the last 3 years, there has been an investment of over 300 million per annum. So this part of our environment is maturing as well, which sets a good basis for an innovation fund. This asset class is achieving outsized returns for its investors, and some examples coming out of New Zealand is the likes of Rocket Lab and NZX that started here, has scaled globally, and are now exceeding $1 billion in value. And finally, we see this as an essential small part of an investor's portfolio to helping achieve the higher returns across their investment activity. So let's just look at the company journey. It's quite a useful way to demonstrate where we invest as part of the investment, the innovation fund. This image shows you what is referred to the J-curve. So that blue line shows a company's evolution from that pre-revenue start to growing in value as it secures its customers, and then how that scales into markets to build mature companies. So for these companies, new capital is required along each of those stages of growth. And in the early stages, you can see from that J-curve that building value is slow, but then it rapidly grows over time. And it's well understood also that in this investment category, that not all companies are going to succeed. 10 to 20% are likely to fail, 20% are going to achieve those really significant outsized returns, while the remaining will return original capital and generate some returns. And so the Booster Innovation Fund aims to invest early and then continue to back those that are accelerating up that curve. There's 4 key parts to our investment strategy. So as mentioned, we aim to invest early in those that have potential to generate significant value. We look to build a diversified portfolio, and that's a key attribute of this fund to ensure that some of those missteps don't compromise the fund. We then look to invest further in those companies with the highest growth potential. And what underpins all this, and as mentioned earlier, around that changing and maturing landscape of New Zealand's venture capital community, we look to partner with these investors as we go into each investment. And that's kind of a key piece where we're adding capital to this important asset class rather than competing. So we've been investing in this asset class since 2018 now. We've had a steady and promising start. In 2022 is when we listed the fund, and it was valued at 5.9 million, and this is now exceeding 16 million across a number of companies. And this value build has come from us investing to build that portfolio, but more importantly, it's the company's success in launching their products, securing strategic partnerships offshore to help grow their businesses, and also securing additional capital to accelerate their growth plans. And you can see on the chart on the side there, the returns since inception are now at 23%. So as I said, quite a promising start for a fund of this type. Noting though that it is at that high risk spectrum of investments, and what we're doing is also investing alongside our investors to help share and build the portfolio and share in those returns. This means that we're very aligned to our investors' goals as well. So I love this slide. This is a great visual to show you all the young companies that the Booster Innovation Fund has been supporting. And we're invested in companies that have big ambitions. They're really pushing that status quo, and they're addressing global challenges such as climate change. How do we improve healthcare? How do we improve food security? And also, how do we find more efficient ways to use scarce resources? Collectively, these companies are employing 350 individuals into high-value jobs. And collectively, the enterprise value of these companies is estimated at 500 million. So BIF and our investors have a small slice of this growing value and future set of companies. But as you'd expect, and as we've anticipated, when you invest, there is often market uncertainties for each of these companies to navigate. Some of these companies will fly to huge success, but some will fall away. And we're already starting to see that play out in our portfolio. But that's one of the key attributes of what we've been focused on over the last couple of years, because diversity is key in kind of investing in this. This slide here is showing you how we think about diversity. This graph shows how the companies are spread by stage. So effectively, where are they at on that J curve I showed earlier? So when we invest early in those younger companies, we place smaller amounts of capital, and as that certainty grows, then we can move into further investment amounts. Sector diversity is key in both of the other, and as Chris has talked about how they think about diversity, we also do that here in this fund, where we're spreading investment across different markets, different technology solutions, and also different timeframes for those companies to generate and secure their first sales. For example, in medical, there's a regulatory pathway before you can launch a new medical device. So that's often longer than a software company that is being able to build up that momentum with its customer base in a shorter time frame. That lower bar on the bottom is showing how each individual company contributes to the total value of the fund. And what's important to note in terms of this stage of our investment journey is that no one company is dominating that fund value at this stage. So I'll take you and introduce you to a couple of our companies. So this one here is Allegro Energy, and they're helping the electricity industry transition to cleaner energy solutions. So Thomas and the team first originated from Victoria University of Wellington, following their unique battery technology discoveries. So they've now established themselves in Australia, and this has been an important step as they have now secured the interests of Origin Energy, who's a billion-dollar Australian utility company, and their involvement is really highlighting the significant increase in Allegro as this partnership really helps validate that market need, but it more importantly shows a way and a path for that technology to kind of really be taken up by these industries. So Origin have partnered with them and investing so that they can really start to bring some of these new innovations into their infrastructure assets so that they can provide really reliable and clean energy solutions to its customers for the future. So we invested in this company early in its journey, and so now we're seeing evidence of that value building company. So another one here that I wanted to introduce you to is Biolumic. They originated out of Massey University, and what they've done is they've developed a UV lighting system which helps to improve plant growth and yield in important food crops. So really thinking about that food security need as the population of the world grows. So they use their UV light technologies to really enhance some of the biological mechanisms in seeds and seedlings so that the crops are higher yielding and they're more disease resistant. So effectively it's what the sun does and how the plants react to the sun's UV environment. So they've accelerated and harnessed that to be a bit more deliberate. So again, another reason why we're seeing value build in this company is the quality of the partnerships that they're securing to really scale their business and take their solutions into global markets. With their recent announcement with Grow Alliance, there is a big step forward. And again, we're investing in these companies prior to some of these kind of significant events which are driving that market uptake and scale on that J curve again. So I guess one of the questions is how do we learn about these opportunities in the market? How do we get access to this quality pipeline? So we've got three parts to our approach here because this is really we are partnering with two of New Zealand's universities' technology transfer offices, Wellington Univentures and Otago Innovation. This gives us a really early look into their pipeline and the opportunity to partner with them as those inventions are being moving into new companies so we can get in early there. We also partner with specialist investors. So each of those company logos that you saw, we invest alongside a number of venture funds in New Zealand or some of the angel groups in New Zealand. And to ensure that there is alignment, we have regular pipeline meetings. We share what we're seeing in the industry and start to prioritise that way. So there's those partnerships, that dialogue, and also there's other avenues into the university. So we invest quite carefully in making sure that we're known and we understand what's in New Zealand's kind of pipeline and that kind of innovation landscape. Just a quick run through in terms of our investment process. We've got three goals that we look for. So we're aiming to do 7 to 10 new investments a year, and this is really to hover around that about 40 to 50 holdings in the portfolio. And then as we kind of build that portfolio, opportunities to further invest in those higher growth companies is kind of where we then allocate more capital. The investment process has multiple steps. So I talked a little bit about the deal sourcing. There's a due diligence piece, and some of the criteria that we consider important is, no surprises here, the quality of the people and that leadership in that company. There's that New Zealand origin story. Has that idea originated out of New Zealand or has it been developed here in New Zealand? That market, the growth potential in there, but more importantly, how is that company going to get to its first customer? And how does that build to a substantial market share? The investment partner, so we, as I said earlier, we only go into an investment if we syndicate with an investment partner that we're familiar with. So there's a number of key stakeholders that also support that investment process. We have advisors around the process with insight into the startup journey ecosystem. So we lean on that to inform our decisions. The investment committee is an important part, and then we also, for each transaction, our scheme supervisor, the public trust, has oversight across each of those. Post-investment, there's quite a discipline around that valuation monitoring because we need to price daily. So we consider new information in real time, and then each month look at that portfolio's performance and the individual holdings, and if there's anything that's happening, then we can adjust accordingly. Each quarter we do a deeper dive on the portfolio, and then we're independently audited by EY. So we've got a number of checks and balances to monitor the performance and the holding values. And I guess what's quite interesting is that in our trading on the NZX and the net asset value tend to be very closely aligned. So the market is agreeing in some respects in terms of how we're pricing those assets. So there's a couple of ways, similar to how Chris described our property fund, to invest in portfolio. So either monthly as a fund issue units, or daily trading on the NZX. That graph there is showing the growth in the value of the shares from first listing through to today's price point. Fees around this venture type fund are consistent with industry standards, with some exceptions. So there's no annual management fee. Typically you would see a 2% management fee for these kind of funds. We cap our admin fees, which means we're ensuring that our investor base understands those admin fees. The annual performance fees are payable as units in the fund, whereas in other types of funds you tend to get sort of performance fees paid out in cash. We've set a higher hurdle rate for this fund at 10% compared to others at 8%. And so what that means is investors in this fund who want to get access to this category can expect a competitive fee structure that ranges as illustrated there. So one of the challenges investing in this end of the market is it's restricted often to wholesale investors. So this will be one of the first available products where all Kiwis can back these young and high growth potential companies. And the other side of that is how we've really addressed liquidity for those investors. Because if you invest directly into those young companies, you are subjected to their timelines to creating liquidity. Whereas in this fund, you have the ability to sell on the NZX, you have the ability to withdraw your investment through the fund, and then there's also, as events happen within the portfolio, the opportunity for cash distributions to come through. So I think that's a quick run through of the fund and where we're at in terms of the portfolio size. Just some of the key takeouts, just to take away with you. One of the key things that makes this fund exciting is that diversity and spread. The way that we're positioned in the market does give us a truly unique way to access those quality opportunities out of the university and research community in New Zealand, where our investors are investing alongside specialist investors in each of those transactions. They're investing alongside Booster, who's putting in its own capital, and also Booster's KiwiSaver schemes have some small exposure to this fund. there's that attractive fee structure. And we're targeting those outsized returns, 10 to 20% per annum, and that unique liquidity option is true advantage around helping people kind of come into this asset class and then again moving up in their own personal investment goals. So I think I'll leave it there. And if there's any questions, happy to take those now, or we can deal with those in slower time.
Yeah, no immediate questions, Melissa. So we do encourage people to send those through, and we'll get some answers over to you. Just in the interest of time, we'll move on to Paul, because he is in the background waiting very patiently. Maybe just a quick one from me, Melissa. Just interested to hear from your portfolio companies, what are the differences in terms of aspiration? Is it all about going global? Is it regional? Is it domestic? Just a quick, maybe very quick insight into how people position themselves in terms of those target markets.
That's a good question. I think for us to buy into that high growth potential, they all need to have that global ambition. So we need to be convinced that any one of those companies has a plan to build a $100 million to $500 million company value. And unfortunately, not many industries or many companies could just focus on the New Zealand market to achieve that.
Excellent. Okay, that's interesting to hear. Melissa, we'll see you again soon. I do also just note that we did do a podcast with Melissa earlier in June. So if people do want to check that out, that's on Spotify as well. Melissa and Chris, thank you very much for your presentations this morning, and see you again soon. And we'll move now on to our final presentation. Paul Harrison, again, thanks Paul for waiting in the background there very patiently, is Managing Director and Portfolio Manager at Salt Funds. Salt is an active fund manager with an investment philosophy that centres on the belief that share markets have characteristics that lead to market inefficiencies that can be exploited over time to deliver superior risk-adjusted returns. I think, Paul, you're going to talk about the CO2 carbon fund, which is listed on NZX today, A lot been happening in that space over the last few weeks, so very interested to hear your reflections on that. Paul, over to you, and I'll be back with some questions in a few moments. Thanks. Paul.
Thanks, James. You can see that slide, it's okay?
Yes, we can see your presentation. Yes, Paul.
Okay.
Yeah.
Awesome. All right. Well, thanks for that, James. Yes, I'm going to present on the carbon fund. As James mentioned, it's listed on the NZX. You can trade it on the NZX. You can also apply. We allot units on a weekly basis based on the NTA of the fund. Here's the legal disclaimer. Obviously, from the lawyers in the firm here want me to express that I'm not giving anybody advice, but anything that you decide to do is not advice from me. This is the history of the fund. We listed the fund in 2018 when we identified carbon allowances, carbon credits as a potential commodity that was along the thematic of the intensity of the action that was going to be required to fight climate change. Putting a price on emissions was going to be very important. The fund has done pretty well since we listed it. It's been a good journey so far, and I think there's a little bit left in this story, or a lot left in this story from here. As you can see, the fund has reflected what's happened mainly in the New Zealand market, and had a little bit of a downslope there in terms of the last 9 months or so, and we can explain that as we go forward. The one thing here, I just thought I'd set the scene. New Zealand, from a climate change perspective, is not viewed very favourably internationally. This chart is from Climate Action Tracker. New Zealand, we tend to be over-promising, but very much under-delivering on our climate change responsibilities. As you can see there, that black line is the historic line of about 80 million tonnes of gross emissions a year. We have made some commitments under the Paris Agreement to bring that down, but we've been very, very slow. Currently, we're on a path to be more like online for a +4 degree increase in temperature, not the below 2%. that everybody should be on. Just moving on, this is the Paris commitment that we've made. So we signed up to Paris Agreement back in 2015. We've since then increased our commitments to do what we can on climate change. So what I've got here, this chart has come from data from the Ministry of Environment. The blue columns underneath there is the emissions that is forecast for the agriculture sector. The green bars on top of that are the emissions that are contained within the emissions trading scheme. As you can see, they total out about 80 million tonnes. The forecasts are for us to slowly have a declining amount there, but as you can see, it's only very gradual. The dark blue line that goes straight across is where we need to be based on our commitments we made under Paris. The orange line effectively is what we will report to the UN as to where we're going. A lot of that decline that you can see in that yellow line there is really due to the increase in the amount of sequestration or absorption from forestry. The difference between the yellow line and the blue, that's about 114 million tonnes, so we're going to miss our Paris commitment by estimates of around 114 million tonnes. So that could be very, very expensive for New Zealand. The recent changes in price notwithstanding, you're still looking at anywhere from probably $7 billion to $10 billion make good provision there for New Zealand taxpayers. If we had to go into the market and buy them from the EU, it gets significantly more. You're talking maybe $17 to $22 billion. The recent EU free trade agreement also has effectively put a commitment in here for New Zealand to meet its Paris commitments. Before we did that, we had some sort of softer commitments under Paris that wasn't really as well defined that what would occur if we didn't get to this, but I suspect the latest EU free trade agreement will now really commit New Zealand to make good on its obligations under Paris. This is a further extension of the projections out to 2050. You can see again that yellow line just declines. This is the yellow line that we're going to report to the UN around what we're doing. You can also notice that the blue columns there, which is the emissions from agriculture, declined very little over that period of time. The big changes really are coming through in the green bars there, which is the assumptions around what's going to happen with the likes of energy, transport waste and industrial processes. The initial phase, we have quite a decline in energy, so that's the electricity sector in particular. And then in the later part, it's more around transport as we stop driving our cars. The other thing here is, again, it's forestry is doing the heavy lifting in these assumptions. So I think these assumptions look a little bit optimistic, and the rate of decline in our gross emissions, we just haven't seen anything like this in the last 4 or 5 years. So it's pretty doubtful that we're going to get this without any real kind of pressure coming on. So just in terms of those green bars, the emissions trading scheme is made up by the government, effectively saying that emitters or polluters need to make good on their emissions. They need permits or allowances. Those allowances get supplied into the market either by the government through auctions or through credits that are sold into the secondary market via the forestry. So the grey bars there along the top there is effectively forestry units coming in. The green bars on top of that dotted line is supplies from the auctions that the government's putting in. The dark blue below the line is effectively industrial processes, electricity, and you and I driving around in our petrol and diesel cars. As you can see, it doesn't really decline much, but that will come back to that auction volumes along the top there in a minute as well. The idea with this is you have a slowly declining amount of credits that are available, so you're forcing down what the emitters can actually emit. In terms of pricing, in terms of what's going to drive why you put a price on emissions, This is an interesting chart from the Ministry for the Environment. This is what they call a marginal abatement cost curve. This is designed to show what kind of price you need for to be paying for carbon to encourage people to change their behaviours, change what they're doing. The dark red line bars on the left there, that is really around the idea that an electric car is much cheaper to drive than a petrol car or a diesel car, so it makes sense for you to change it. There is also an element of savings in terms of healthcare, just the costs that are imposed on the healthcare system from people breathing fumes from diesel and petrol. So reasonably theoretical. Not everybody wants to drive a Prius or a Tesla, and not everybody just looks at it purely on the economic basis in terms of what kind of car that they have, whether it's a combustion engine or an electric car. So I think that's a little bit optimistic there again. To the right there, you can see the dark blue columns here. That's the electricity sector that's really changing its ways in sense of going towards renewables. That is obviously at below $100 a tonne, and we're seeing that now. The more sticky parts to the electricity sector requires probably closer to $100 a tonne to force some changes, and certainly that's what we have been seeing through conversations that we have when we on our equity portfolios. Further out, you can see there's a big chunk of our emissions that are going to require $100 to $250 a tonne to really encourage them to come out of or to change their ways. The one thing to remember here, though, these are all economic assumptions based on certain things, and you may find that some of those, the cost may come down a little bit with subsidies or whatever, as we are seeing from the government to encourage industry to change. So, you know, we obviously need an appreciating carbon price. We haven't had one since sort of December last year, and that's obviously not ideal for pushing emissions out of our economy and meeting our Paris commitments. What's happened? Well, December last year, the government decided not to accept the Climate Change Commission's recommendations on the price settings and the volume settings. That saw a lot of nervousness come into the market that the government wasn't committed to the ETS anymore and an appreciating price. The result of that is the government option in March did not clear. The one in June did not clear. So we've now got one in September that's got about 13.5 million NZUs to sell. There is a real possibility here that we don't sell any units this year. And, you know, to give you an idea, 15 million tonnes of NZUs the government was going to auction off is probably worth around almost $1 billion. So it's $1 billion of revenue the government won't be getting. And so they're needing to look at this and why they have changed it. On top of this, we've also had some fears around forestry and too much forestry NZUs coming into the ETS. The ETS only represents half of the demand in the economy. So while we need these forestry plantings, there is a potential for the NZUs, the credits coming from forestry could overwhelm the demand in the emissions trading scheme because we do not have agriculture in that scheme. The government has outlined a review of the ETS and how forestry fits, and 4 options. Some of those options have created major uncertainty for forest owners. But more positively, the recent court cases forced the government to actually review the decision from last year, and we've seen that price bounce a little bit. The government updated its settings. As you can see, these are the number of carbon auction units that will be available. So 2023, 15 million tonnes, dropping down to just under 7 million in 2028. So that's about 3 million tonnes a year reduction. They have also set a minimum price on how much they will charge for a unit in the auction. So from December, that will be $60, rising to $64 and onwards. So there's been anywhere from a $27 to a $30 increase in the price that the government is willing to auction units off. We've also had a problem in New Zealand with this cost containment reserve, the idea of a little bit of a reserve amount of NZUs they can drop into the auction to supply some more units. They shouldn't have been doing this. And what's happened here is this has really been taken out of reach. So those extra units won't come into play until you're up into the 180s, 180 and higher now. So it's unlikely that you'll see those come in. So the real volume that's going to be put into the auction system is that line along the top there. The ETS consultation, this is probably the thing that's created the most disruption to the market. The government is talking about potentially not allowing forestry units into the ETS. They have some forecasts, which we can have a look at the moment, where there is too many units coming in. This uncertainty of potentially existing forestry units or future forestry units not being allowed to be used by emitters has created a divergency in price. We're seeing anywhere from $2 to $3 difference now between a forestry unit and a non-forestry carbon credit. The problem we can see, and this is what the government's identifying, is the price to encourage forestry is lower than what it is to discourage emissions. We think, based on the research we've done, you probably need $35 to $40 a tonne for your carbon credits to encourage forestry plantings. The price to discourage emissions is higher. It's probably well over $70 to discourage that. So obviously there's more upside in NZUs created by non-forestry than there is for forestry if the government decides to be the buyer of forestry NZUs and not allow them into the ETS. That pricing that they will charge or pay you for your forestry units is very uncertain at the moment. Needless to say, we took a conservative approach on this. The carbon fund switched out of any forestry removal units we have. We now only hold non-forestry units because that's where we think that the major upside is in this price. So why is the concern around forestry when we actually need these? This is a chart from MPI. It's actually 2018 to 2022. You can see the plantings there that have gone into the ETS. So we took 10 years to get 300,000 hectares in there, and then in the last sort of 18 months or so, we've jammed another 200,000 in there. A lot of it's due to the increase in the carbon price, but also this is some of it will also be some of the billion tree program that we had. This is what has wound the government up and its various departments. As you can see on the blue side, the blue bars here, this is the historic plantings we've had up and down in the forestry amount that's been planted in forestry. You can see the 2021, 22, 23, there's been an increase in forestry. The boffins in the government have created quite in detail forecasts, but they've come up with a nice smooth line of 40,000 hectares a year forever being planted in that. So there's significant forestry being planted in their assumptions, and regardless of the price of land or regardless of what actually might be happening with the price of NZUs, that they assume that pricing, those volumes keep getting planted in forestry. They then turn around and they overlay that forestry planting on top of their assumption around a rather optimistic reduction in the gross emissions. And as you can see, by 2035, the forestry overwhelms the amount of carbon credit demand in the ETS. I don't think this will occur. I think you'll have probably a slower decline in the emissions. I think the forestry slows down. They do need to sort forestry. Having said that, they do need to sort forestry out. You hope that they will come to something sensible. Perhaps existing forestry in the ETS gets grandfathered in, and then from 2025, any more forestry planting that want to be paid for sequestration then need to tender in to the government their project. That way the government can control what forests get planted where and what type of trees they get, and have much more control over what that is. And then the ETS gets allowed to get on with its own thing, and we have an appreciating price in that ETS to allow that will to discourage emitters from emitting and consumers paying ever higher price for carbon. I've squeezed what was a 30-minute presentation into probably 10-15 minutes. I think the key point I would let you go away with is there is a broad political commitment to a robust emissions trading scheme. What we are seeing is some issues that have been identified with some recent changes that were made around forestry. I think they will sort this out, and it will inevitably lead to a much stronger emissions trading scheme. The next key event is the NZU auction that we have on the 6th of September. This is a very interesting event because this will be held under the old rules. The minimum price the government will auction that off is $33. There is obviously a secret reserve price. We have taken a lot of incoming from big investors from offshore out of Europe, the US and Asia interested in this auction. This may be the cheapest NZU auction units available for some time. So whether they can clear 13.5 million tonnes will be a close call, but that will be very worth something people keeping an eye on. And that's my presentation.
Paul, fantastic. Thank you very much. A lot to digest there. I'm conscious people will be either watching live or after the fact might be cycling back through some of those slides. Very topical, very relevant, I think. I mean, my first question, we haven't actually got any questions from the audience as yet, but I'm sure people will come up with some as they kind of reflect. But I was going to ask about that cross-political support. So, and I think you commented there on the last couple of slides. So just to reiterate, perhaps, so is it my understanding that there is consensus as we move towards the election in terms of the structure of the scheme, notwithstanding the kind of uncertainty around forestry?
I think forestry is probably the key difference. But having said that, this consultation period will go into August. Obviously, they won't be able to pull it all together before the election. The government has said that the decision around the structure will be left up to whoever's in government next year. I think there is broad consensus around the requirement for an emissions trading scheme and a price on carbon. The likes of National and ACT have said that they would prefer to see the ETS do the heavy lifting with a price. And we've also seen National come out and talk about reducing the amount of forestry that is being planted. You know, we have seen quite a lot of planting going on. Some of it probably reflects the lack of profitability, if you like, in sheep and beef farming. I mean, dairy's also got a challenge. I think the average dairy farmer is going to lose something like $150,000 this year. So whether that changes or not, I think there is broad commitment. National, I think Simon Bridges signed the Paris Agreement. That they are committed to it, and a price on carbon makes a lot of sense. ACT has talked about the average of the trading partners. If you take a rough guide around what the price is in Australia and California, China, Europe and the UK, you come out with around $80 a tonne, New Zealand. So I think it's important to do this. The biggest issue around a price on carbon is encouraging companies to invest in renewable energy, reduce their emissions. And it's also the consumer. I mean, a big part of this is you and I driving around in our petrol cars. You know, every litre is 2.4 kgs of CO2 emissions. And at the moment, we're paying just under 15 cents a litre based on a $60 price. You know, what price do you need it to go to before you stop driving your petrol car around?
Yeah, and that's an interesting question, and whether you, how much, I guess, consumer patterns actually change as you get up into those high prices. I guess it's just a final question, perhaps, and part of my ignorance in terms of how you operate the carbon fund. How do you, as you go through as we cycle through these auctions, maybe past and as we move forward, you're looking for essentially a return based upon holding credits that will appreciate in value. Would that be accurate?
That's right, yeah. I mean, when we started the fund, we had a view that we would invest in markets where we could see the government was significantly behind the commitments it had made. New Zealand is significantly behind, and you also need the political consensus and commitment around this. It's had an unfortunate sort of setback in the last few months, but I think that will be sorted, and that will result in something a lot more robust. And you know, so yeah, the idea is that we do think an appreciating price in New Zealand is needed, definitely needed in Australia, but they've got some issues that are just working their way through as well.
Great, fantastic. That sounds like a pretty good place to conclude. So thanks very much, Paul, and again for your patience, kind of waiting around in the background there. I'm sure we'll have you on again soon. Enjoy the rest of your day. So thanks, Paul. And yeah, so that concludes today's virtual investor event. Hope everyone enjoyed that. Again, if you do have questions, if you're watching this on a kind of on a recording, you can still send those through. Next event is on the 23rd of August, where we're going to be talking about debt. So we have the LGFA and Transpower presenting. We also have Hobson Wealth as guest speaker, kind of reflecting on the debt market funds today. We've done equity before, so cycling through those asset classes. So that's 23rd of August. Thanks once again to everybody, and see you again soon. Enjoy the rest of your day. Bye-bye.